Assalamualaikum warahmatullah and welcome everyone. In this video presentation, we will discuss deferred tax that are relevant specific to business combination. Also, I would like to give credit to IFRS community for their discussions on deferred tax, Grant Thornton International IFRS team for guideline on applying IAS 12 specific to deferred tax and business combination, Corner iTax and Accounting, and Aryan Broa and Yvonne Nardin for their insight on making deferred tax relevant. Before discussing deferred tax specific to business combination, we will first revisit deferred tax just to refresh our memories on what deferred tax is and how it works. For that matter, we will also discuss some provisions in MFRS 112 that are relevant to deferred tax in general and specific to deferred tax and business combination. Then we will discuss sources of deferred tax and business combination, some of which are fair value at acquisition, liability with tax effects at acquisition, additional assets or liabilities recognized at acquisition, something on deferred tax liability on goodwill, deferred tax due to initial recognition, unrecognized deferred tax assets by acquirer and acquiree, and lastly, deferred tax in intragroup transactions. At the same time, whenever relevant, we will also discuss whose tax rate that will be used, given that the acquirer has different tax rate from the acquiree, and a note on measurement period where any adjustments to cost of business combination, thus goodwill, is allowed within the period and not after. Let us start with revisiting deferred tax and some provisions in MFRS 112 that are relevant to deferred tax in general and specific to business combination. The first thing that we want to remind ourselves is why. Why should we even bother about deferred tax? First, we prepare financial statements based on accrual basis, so is deferred tax. Second, the effect of deferred tax is either increasing tax expense or decreasing tax expense, so presenting deferred tax separately would allow users to have better information about the company's well-being. And third, in the calculations of EPS, which is one of the most used tools to analyze a company's performance, it uses profit after tax, thus tax expense must be determined with accuracy, such that everything relevant including deferred tax should be taken into consideration to avoid distortions of tax figures, thus the EPS itself, or any other tools that use profit after tax. Since we have already discussed deferred tax in previous course, we know that deferred tax is referring to income tax payable or recoverable in future period, thus the word deferred. And the sources of deferred tax would be due to temporary differences, unused tax losses and unused tax credit, of which the last two are relevant to deferred tax asset only. We also know that deferred tax exists due to differences in tax rule and accounting rule, which creates the temporary differences in payment of tax. We know that accounting applies accrual basis, while for calculating tax expense, the IRB or LHDN uses cash basis instead. In the end, for accounting, we end up with accounting profit in income statement, but for tax purposes, we need to take a step further to determine taxable profit instead. Because of that, whatever tax expense calculated based on accounting shall be adjusted by deferred tax asset or deferred tax liabilities, as accounting profit be adjusted to get to taxable profit. Just a quick look back. Due to differences in the rules, consequently we will have two differences, permanent differences and temporary differences. For permanent differences, they come from non-deductible expenses and non-allowable income, thus it will be permanent adjustment from accounting to taxable profit. This type of differences will not result in deferred tax, since the adjustments will also be permanent. The temporary differences is due to timing differences. It will be taxed, or tax will be deduced, but only in the future. For this type of differences, if the consequence is deductible temporary differences, it reduces the amounts of taxable profit. Therefore, it resulted in deferred tax assets or DTA. On the other hand, if the consequence is taxable temporary differences, it will increase tax in the future. thus resulted in deferred tax liability or DTL. For example, we know that depreciation is not deductible, but IRB allowed for capital allowance that will replace depreciation, and it can be deducted from taxable profit, thus reducing tax expense. So if an asset is eligible for a capital allowance, depending on the rule, that is, depending on when the capital allowance is allowed to be deducted, we could end up with DTA or DTL at a certain financial year end. Other examples of sources of deferred tax would be expenses and revenue, cash versus accrued, allowable income not being recognized and allowable expense not being recognized by accounting rule for a certain financial year. For the method to determine deferred tax, we, as in Malaysia, we use balance sheet liability method, where we need to go through all items in SOFP, identifying relevant items with temporary differences, and determine the deferred tax from there. An important point in determining deferred tax is the tax base. Tax base is simply the amount attributed to the assets or liability for tax purposes. In short, tax base for an asset is equal to the amount deductible for tax purpose in the future, and tax base for liability is its own carrying amount minus the amount that will be deductible. So if the carrying amount of an asset is less than the tax base, or carrying amount of a liability is greater than its tax base, we will end up with a deductible temporary difference, thus deferred tax asset. And if the carrying amount of assets is greater than tax base, or the carrying amount of liability is lesser than its tax base, we will end up with taxable temporary difference, thus deferred tax liability. As per paragraph 15, we are required to recognize deferred tax liability for all taxable temporary difference, and so we debit tax expense and credit deferred tax liability, except when the DTL arises from initial goodwill for business combination, and that can only happen if there is a temporary difference arising from differences between book goodwill and tax goodwill, and also, of course, difference between accounting rule and tax rules on goodwill. We also ignore DTL if it arises from initial recognitions of an asset or liability in a transaction that is not business combination, meaning for individual entity, that is. Now, even this second exception is for individual entity. It could be a source of difference if the entity is taken over by another entity, and DTL has to be recognized at consolidation regardless. We will look at this later when we discuss specifically deferred tax in business combination. As per paragraph 24, for DTA, we must recognize DTA for all deductible temporary differences, but only when we believe that it is probable that taxable profit will be available against which the deductible temporary differences can be utilized. We have to understand that DTA can only be utilized against taxable profit, thus reducing it. Therefore, if we do not have taxable profit, the unused tax credit or tax losses cannot be utilized. Thus, recognizing it will be debiting deferred tax asset and crediting income tax expense. This means that the tax expense for the current year will be reduced, and of course this should only be applied with some degree of prudence so that assets are not overstated. And this is also the reason why DTA shall only be recognized if we are more than 50% sure that there will be taxable profit available. As a matter of fact, if DTA unutilized in the coming year, in other words, there is no taxable profit for that year, this is a proof of the company not benefiting from the DTA. Thus, we will be asked to reverse the recognitions of DTA earlier, or in other words, eliminate DTA, unless at the same time we have DTL to offset it with. However, whether we can offset DTA with DTL, IRB or LHDN will be the one who decides. This applies unless, like DTL, the DTA arises from the initial recognitions of an asset or liability which is not part of business combination. So whenever an entity recognizes an asset or a liability for the first time, in that year, it shall be excluded from the calculations of deferred tax. And similar with DTL, at group level or at consolidation, acquirer still need to recognize that DTA if it is believed that the future taxable profit will be available. When DTA or DTL is identified and calculated, it shall be included in the determinations of current year's tax expense, where the current tax, which is calculated from taxable profit, will be adjusted with the DTA and DTL. Now that we have looked back at deferred tax and some provisions in MFRS 112 on deferred tax, we can now focus on deferred tax that are relevant to business combination. Before we go through the sources of deferred tax, let's go through some of the provisions relevant to business combination. First, paragraph 39 of the standard requires entities that have interest in other entities to recognize all DTL associated with that other entities, unless the parent can control the timing of the reversal of the temporary differences, thus no temporary difference would occur. And it is probable that the temporary difference will not be reversed in the future, thus will not result in DTL. Paragraph 44 requires the same for DTA. Entity with investments in other entities shall recognize DTA from its investments in other entities. And similar with individual entities DTA, it shall not recognize unless the entity believes that it is probable that the temporary difference will be reversed and taxable profit will be available for it to utilize the DTA. Having those provisions in mind, let us look at the first source of deferred tax in business combination. We know by now that whenever there is an acquisition, all identified assets and liabilities of acquirees shall be recognized at their fair value. This will change the carrying amount, but the tax base would remain the same, and this will result in temporary difference, thus deferred tax. And consequently, it will change the amount of goodwill at acquisition. For example, say that the carrying amount of an asset in acquiree's book is at 100,000 ringgit, and its fair value at acquisition is 120,000 ringgit. Tax base of the asset remains at 100,000 ringgit, which can be equivalent to the cost if acquiree applies cost model. At group level, there will be taxable temporary difference, and this will affect goodwill acquisition. Now say that, for simplicity's sake, the tax rate is at 25%, the identified net asset is at 750,000, and the consideration is 970,000 ringgit. So now we have taxable temporary difference of 20,000 and thus a deferred tax liability of 5,000. If we ignore deferred tax, the goodwill will be at 200,000. With deferred tax, lowered the value of identified net asset and thus increases the goodwill by the amount of DTL. Just a note, on the left is what we refer to as the book goodwill, and on the right is what we call as tax goodwill. So when we eliminate the investment and recognize goodwill, the deferred tax liability should also be recognized. And then we have situation where we have liability with tax effects at acquisition. Paragraph 26 requires acquirer to recognize the deferred tax arises from a liability that is deductible only in the future, thus a DTA. For example, we have accrued expense of 5,000 which only be deductible when it is paid. Basically, this applies to most expenses under tax rule. This results in deductible temporary differences, thus DTA shall arise. Say that the entire amount of accrued expense is 100% deductible when paid. The tax base will then be 0 and the deferred tax asset will be 1,250 ringgit. Before we recognize it though, remember to give it a thought. Will there be a taxable profit available for the benefit to be utilized. The goodwill with DTA will then be 218,750 ringgit. The subsequent journal entry when eliminating the investment and recognizing goodwill would be as presented here. Now what if we have additional asset or liability added to the identified net asset only at acquisition? This is when acquirer recognizes something that acquiree does not. Say for example, an acquirer valued customer contracts in acquiree and recognized that as an intangible asset at acquisition, that it will be part of the cost of business combination to acquirer. Given here, the value of the newly recognized intangible asset is at 250,000, but it is not deductible. Basically, this applies to all intangible assets. Amortizations on it will not be deductible. Therefore, the tax base is 0. Nothing deductible in the future for this asset, and therefore the DTL is at 62,250. Taking into considerations of the DTL, we will get a goodwill of 32,500 ringgit. For the new intangible value, since it is not in the book of the acquiree, it will be only recognized at group level. This could be included in revaluation reserve or retained profit. Thus, when eliminating the investment and recognizing goodwill, deferred tax should be included. In other jurisdictions, like Australia, it recognizes business combination valuation reserve or BCVR at the value net of tax. On DTL for goodwill, this requires special attention. First, the standard requires recognitions of resulting DTA and DTL from identifiable net assets at acquisition date. Consequently, these DTL or DTA, as we have seen before, will affect the amounts of goodwill. However, the standard also prohibits any DTL that arise from the initial recognition of goodwill, basically at acquisition. That will be the first time that we recognize goodwill. We have seen before that recognizing DTL from assets and liabilities could affect the amounts of goodwill from book goodwill to tax goodwill, suggesting a possible DTL. However, the standard does not allow this, since this would create additional taxable temporary difference between tax goodwill and book goodwill. The standard also states that any subsequent reductions in a DTL that is unrecognized because it arises from the initial goodwill that will remain unrecognized will also regarded as arising from the initial recognitions of goodwill, unless it can be shown that the difference is in fact not arising from the initial recognitions of goodwill. Please remember that goodwill shall be relevant to deferred tax if it is deductible, meaning when it is amortized or impaired, the expense can be deducted from taxable income. If the tax rule states that it is undeductible expense, thus which applies to most jurisdictions, the tax base will be equivalent to 0. Nothing can be deductible from this intangible asset. Therefore, there should be a deferred tax liability. In this example, if we take the tax rate at 25%, the DTL should be 25 million. However, we are not allowed to recognize this DTL at initial recognitions of goodwill, so it becomes unrecognized DTL. In subsequent year, say there has been an impairment loss of 20 million, thus reducing the amounts of goodwill to 80 million. At this point, the DTL should also reduce to 20 million at 25% rate. This reduction in the unrecognized DTL shall not be recognized since it is regarded as related to the initial recognitions of the goodwill. Now compare that to this example. Say that goodwill is included in the allowable expense under tax rule, thus making it deductible for tax purpose, and in this example at 20% a year. So if the carrying amount remains at 100 million, since no impairment loss recognized in the book, thus there arises a taxable temporary difference of 20 million, now that the tax base reduced to 80 million at the end of the year. A DTL of 5 million is allowed to be recognized since it is not regarded as coming from the initial recognitions of goodwill. Next, we look at deferred tax liability arising from initial recognitions of assets and liabilities by acquiree. Earlier, when we revisit deferred tax, we have learned that any deferred tax liability arising from initial recognitions of asset and liability shall not be recognized by individual entity. However, in business combination, the acquirer shall recognize those DTL. So basically, we have no recognitions of DTL in acquiree accounts for asset and liabilities that are just recognized in the year of acquisitions on one hand, and on the other hand, we have acquirer that must recognize those DTL at acquisition, so we can imagine that the goodwill amount will be different. For example, say we have taxable temporary difference arising from an asset that is just recognized in the year of acquisition. And using the same example as before, we have tax rate at 25%, identified net asset without the DTL for that particular asset of 750,000, and considerations of 970,000 ringgit. The amount of deferred tax liability will be at 12,500 ringgit. Thus, the adjusted goodwill will be at 232,500 ringgit. And when we eliminate the cost of investment and recognize goodwill, we will need to also recognize the deferred tax liability of 12,500 ringgit. What about previously unrecognized DTA, either in acquiree's accounts or acquirer's accounts? We have seen earlier, regardless of the source of DTA, if we want to recognize it, the standard requires us to think about the probability of having future taxable profit, especially if the DTA arising from unused tax losses or tax credit. And that requirement remains for the DTA arising from investments in other entities. Let's say that an acquirer has unrecognized DTA, and due to a business combination, it believes that the future taxable profit is now becoming probable and would like to recognize the DTA. Now, since this is in the book of acquirer and not acquiree, it will not affect goodwill arising from the business combination. The changes will only be shown in the acquirer's book of accounts. So given in this example, at 25% tax rate, identified net assets of acquiree at 750,000 and considerations of 970,000 ringgit. Also given is the unused tax losses of the acquirer at 150,000, which results in 37,500 ringgit worth of DTA. Therefore, the goodwill remains at 220,000 ringgit, and in the book of acquirer, it recognizes the deferred tax asset of 37,500 ringgit. Now, what if that unused tax losses belongs to acquiree and it also believes, due to the business combination, that future taxable profit will be available for it to utilize the DTA? This newly recognized DTA will definitely affect in goodwill, since it will be part of the acquiree's identified net asset. Given the same information as before, we need to recalculate goodwill, and this time taking into account the DTA of 37,500 ringgit, resulting in goodwill of 182,500 ringgit. When we eliminate investment, we recognize a much lower goodwill. What if the future taxable profit only probable after the business combination? This means at acquisition, DTA will not be recognized and thus goodwill will not be affected. And if after the acquisition date, acquiree recognizes its DTA within the 1-year measurement period, this will require adjustment to the value of identified net asset and the amount of goodwill. If the goodwill reduced to 0, the balance shall be directly recognized in P&L. However, if DTA recognized after the 1-year measurement period, it will directly recognize in P&L. For example, say the tax rate is at 25%, identified net assets without DTA at 750,000 ringgit, consideration at 970,000 ringgit, and unused tax losses was at 650,000 ringgit. The initial goodwill recognized was at 220,000 ringgit. If the DTA is recognized within the measurement period, we have to adjust goodwill. Thus, the new goodwill will be at 57,500 ringgit after deducting DTA of 162,500 ringgit at 25% rate. If the DTA is recognized after the measurement period, no changes will be allowed to the goodwill, and thus the DTA will be directly recognized against P&L. The last source of deferred tax is the Intragroup transactions, where we have unrealized profits. The determinations of deferred tax will be between the carrying amounts of inventory after the eliminations of profits and its tax base. For example, we have here A. Berhad who owns 100% of B. Berhad. A. Berhad then sold 10,000 ringgit worth of goods to B. Berhad at the price of 12,500 ringgit. The goods have not been sold to third party by end of the financial year. Say A. Berhad pays tax at 25% rate, while B. Berhad pays tax at 23% rate. Before we calculate deferred tax, in this case, we need to first determine which rate that should be used, in the event where these entities pay tax at different rates. The basic rule is the tax rate and tax base must be consistent. Whose tax base are we referring to? Thus, that will be the tax rate we use. Or in this case, whose cost is reduced by unrealized profits? In this case, it is the cost of B. Berhad. So basically, we will eliminate the sales of 12,500 ringgit in income statement. And we calculate the deferred tax for the unrealized profit eliminated at 23%, the tax rate for B. Berhad, thus giving us a deferred tax asset of 575 ringgit. Thus, eliminations of the unrealized profit, which is also equivalent to a reductions in inventory value for B. Berhad, resulted in a DTA of 575 ringgit. Now, to reiterate the same question about whose tax rate to be used in the first case of fair value acquisition, the same rule applies. Tax rate should be consistent with tax base, or we ask whose cost is the asset belongs to. So in business combination, the acquirer will be acquiring assets and liabilities of the acquiree. Thus, it is the acquiree that holds the cost of the asset. We could also identify this by identifying the entity that will use the asset to generate taxable profit, and in this case, the rate that applies to subsidiary. The final note is on measurement period. Just as a quick reminder, any changes that occur within the measurement period must be adjusted to either cost of business combination or goodwill or both. But for the case of deferred tax, it will be adjustment to goodwill. If the changes occur after the 1 year measurement period, changes should be directly brought to P&L, thus not affecting goodwill, as we have seen in the discussions of unrecognized DTA by acquiree recognized after business combination. So there you have it, all relevant sources of deferred tax in business combination discussed together with some note on what rate to use given 2 different tax rates and a memo on measurement period. I hope this video has helped you to understand the deferred tax in business combination. You can always play this video again if you think that you have missed something. That is all for now. Thank you very much for tuning in, and I will see you again in the next video. Wassalamualaikum warahmatullahi wabarakatuh.